Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. We are still doing our swag giveaway all month. It's so simple, you guys. All you have to do is subscribe and comment, and you can have access to our swag store. You can geek out with our EBITDA hat, our classic In the Money mug, or our Smells Like a Man in Finance candle. All you have to do is smash that subscribe button and comment. On today's episode, we've got Dennis Mitchell of Starlight Capital. Now, I've interviewed him a bunch of times before, but I have never seen him as fired up as this episode. Yeah, sure, we're going to talk about stocks that he sees big upside in, but he's also really passionate about solving Canada's housing crisis, and his solution may surprise Bay Street. He says we need more government intervention, not less. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. We all want to make the most of our investments. That's why BMO InvestorLine is here. Their easy-to-use platform packed with tools, resources, and commission-free trading on over 100 popular ETFs can help you trade with confidence and take control of your financial future. Learn how you can earn up to $3,500 cash back when you open a new account at bmo.com/online investing. Dennis Mitchell, thank you so much for joining me.
Thank you for the invitation.
I've had the pleasure of interviewing you several times, but I don't think I know. How long have you been investing in real estate?
We're going on 20 years now, so it's been a while.
And how did it start? Were you a generalist first, or did you always have this bug?
I had no experience in real estate whatsoever. My previous boss told me. He said two things. He said, real estate is extremely boring, so we'll get you involved in other stuff later on to keep you interested. And I think real estate's been boring for maybe 15 minutes that first day. And then since then, we've had the financial crisis, we've had the pandemic, and all sorts of lovely things that have made life interesting in the real estate space.
I think you bring up a really good point. Real estate is almost, people think it's supposed to be boring. It's supposed to be defensive. It's supposed to be for the income-oriented investor because you can get really nice yields that are supposed to be stable. That doesn't always pan out, as you mentioned. When you talk to investors about the role real estate is supposed to play versus the role it does actually play, what do you say to them?
Well, I think if you take a step back, securities, whether it's real estate, technology, healthcare, they're all supposed to do things. You add on to that the macro environment, things can change. Last I checked, the president of the United States was kind of a mercurial guy, so injecting a little bit of volatility. And then there's the investor themselves and how they utilize the investment versus how they should utilize the investment. So when you come back to it, real estate is, compared to other sectors, much more defensive, much more stable, much more consistent, and there's way less elasticity and demand for its services. For instance, it's very difficult to name a part of the economy that doesn't take place in some sort of commercial real estate, right? We shop at the mall, we work in office buildings, the stuff we buy is stored in a warehouse or manufactured there. So it's difficult to find a piece of the global economy that doesn't take place within commercial real estate. That makes it very consistent. It makes it essential service. And, you add on the contractual nature of the cash flows from the rents, and you've got an asset class that is more stable, more resilient, more consistent than most other sectors.
It should be. And yet we're in a situation, I'd love to get your 2 cents on this. Everybody talks about this who is bullish on REITs. It's like you can buy real estate cheaper in the stock market than you can if you were to transact and buy that asset itself, meaning these stocks are not fully accounting for the value of the assets that they hold. But is that kind of a tricky thing, like to say that? I think a lot of people say, so that's why the sector is a screaming buy, but that doesn't always mean the stock goes up.
No, just because something is cheap doesn't necessarily mean that's a catalyst for it to become more expensive. But what I would say is this. There are 3 sources of return from any equity you're going to invest in. Okay, there's the yield that it pays, the multiple that it trades at, and the growth that it generates. And when you take those 3 and you superimpose them on real estate right now, they're offering you yields of 4% plus that are extremely tax efficient. They're trading at, in Canada, about a 20% discount to their net asset value. low teens in terms of a multiple of cash flow compared to sort of 15 times cash flow at equilibrium or for long-term averages. And then in terms of growth in Canada, you're expecting sort of 3 to 8, 9%, depending on the sector. So when you put those three variables together, the yield, the growth, the multiple, you've got return potential well north of 20%. So then it really becomes, are you going to be patient enough to allow the businesses to compound on your behalf?
And how do you think about your edge? Like, what's your approach right now? How bullish are you compared to other periods of time?
Yeah, I don't necessarily think that we have an edge. I think when people see us on mediums like this, they just assume that we're super smart. Nobody should be investing in with me because they think I'm super smart. My edge, if you will, is that I have more access to more information than the average everyday investor. We have a disciplined process that most individual investors don't have. And then we have the time horizon and the discipline to actually enact those things over an extended period of time to compound properly.
What's on that checklist?
It's really simple, and we've got tons of white papers on our website that capture this, but we build concentrated portfolios of high quality businesses when they offer us enough return for the risk we're exposed to. Now, everybody says that. You're well versed in this. I'm sure you've heard it from a lot of your guests, but everybody's portfolio is different. So we all can't be doing the same thing, even if we're giving the same message. So for us, what makes a high quality business is 4 attributes. Strong recurring free cash flow from a portfolio of irreplaceable assets that are capitalized with low debt and run by management teams that behave like owners and treat you like partners. And so if you go through our portfolio, you're going to find those 4 attributes across every company we own, whether it's industrial or apartments or seniors housing. Those are the attributes that they all have in common. And then we've been patient enough to wait until they offer us enough of those 3 buckets of the return to compensate for the risk we're exposed to.
And we're going to talk about a lot of these individual names. Don't worry. I know people love to hear about stock specifics, but I want to spend a moment on that sector, because how tough has it been to hold on to that conviction given, since the 2021 highs, the sector, and there's certainly outliers to this, but the sector as a whole has been in the penalty box. It hasn't recovered, the way tech or something else has. The TSX REIT sector is still off about 30% from the 2021 highs.
Yeah, I think a lot of, you mentioned the sector as a whole. So again, when you talk about the sector, you have to be cognizant of what makes up the sector, right? So the US REIT sector is more skewed towards retail. It's got a huge exposure to what we call infratech, towers and data centers. When you come to Canada, the sector is really characterized by apartments and retail. There isn't a ton of office, although we spend a lot of time on it. There's no office, there's no cell towers and data centers, so you have to be careful about that. So when I look at Canadian REITs, one of the challenges we've had is that the sector is perceived to be interest rate sensitive. And it is, but not nearly as much as investors perceive it to be. Okay, so long bond yields haven't responded the way the short end of the yield curve has as central banks have reduced interest rates. And then you have the beginnings of a tariff war being waged by the United States against everyone that has pushed up sort of short-term inflation expectations. So if you look at the 10-year bond yield in Canada, it was close to 3% and close to going under 3%. Now we're back up to 330, 340, 350. Same for the US, where we were going to dip below 4 and we're now closer to 450. For real estate to work right now, you have to have long bond yields start to come down so that people can see the motivation for cap rates to come down and for these things to trade up closer to their net asset values.
That's a great point, and I should have brought it up earlier. The interest rate environment. You can have your checklist till you're blue in the face, but if the rate environment isn't working in your favor, what do you do?
Yeah, I think, again, you're looking at the 3 sources of return. And so one of the great things for real estate is that it pays you very consistent, very stable, tax-efficient cash flows. So some of the REITs that we're going to talk about today, if they're paying you 4% now and they are growing that distribution at, say, 2, 3, 4, 5% per year, our portfolio last year saw its distribution growth at over 8%. That adds up after a while. And then remember the tax characteristics. If you're comparing this to GICs or bonds, you're getting a lot of return of capital for tax purposes from REITs, which means you're not paying tax on that income when you receive it. You'll realize a larger capital gain or a lower capital loss, one of the two, when you sell. So that is a huge advantage for an investor. And remember, Canadian REITs pay on a monthly basis. So when you sit down with your advisor and they start talking about building you bond ladders or pref ladders, you don't have to do that with REITs. You own them, they pay you on a monthly basis. And most people have monthly expenditures they have to cover. So it's a nice match.
So a lot of people wonder, the distributions are there and they grow. The stock price might be volatile and it might have to do with tariffs. It might have to do with interest rates. So why don't other owners come in, and why haven't we seen more M&A activity, specifically private equity activity? We've seen it like a little bit. But considering these huge discounts and the cash flows that are waiting for them on the other side, why haven't we seen a lot of M&A?
Yeah, I think the key word there was more, because there has been. You've seen Magellan, you've seen Tricon, you've seen Summit. So there has been M&A. So really the question is, are we going to see more if these discounts are as large as they are? Again, you have to look at the makeup and the composition of the Canadian REIT universe. So a lot of it is multi-residential, right? So you're not going to see a ton of M&A and consolidation in that sector because there aren't the levers to be able to take advantage of the discounts. For instance, we saw years and years ago, I want to say about 10 years ago, we saw somebody take a run at InterRent. They looked at their balance sheet and realized, unfortunately for them, after they had acquired a big stake in InterRent, that there really wasn't a lazy balance sheet. There wasn't excess debt capacity they could tap into to sort of finance the acquisition of the REIT with its own balance sheet. And then if you looked at sort of the ability to grow cash flows, the existing management team was already doing a decent job sort of capturing the mark to market on an annual basis. So there just really wasn't the ability to capture the upside through operational performance or through financial changes. So really it came down to, if I buy this REIT, what is going to accelerate the realization of upside and value? And if I pay for all of it, there's no other levers for me to use to create additional value. So that is the challenge for the residential sector, because I get a lot of that. On the other sort of, if you take retail or industrial, then you need more of an operational approach. Can you re-tenant the property with better tenants, faster growing, that drive more foot traffic for, say, retail? And what I think you'll find is that the retail operators in this country that run the REITs, like SmartCentres, like First Capital, they're really good at what they do. So there aren't a lot of people out there who could step in and create additional value on top of what these guys are already doing. And then to your point, it's also who's doing the buying, right? So if you mentioned private equity, historically private equity's value has been large checks, right? And long-term horizon. Well, you know, the guys who are already running these REITs aren't necessarily starved for capital, and they've already got long-term horizons. So what is it that private equity is bringing to the space that they don't already have?
This is great perspective. And you mentioned InterRent. We actually got a question in the mailbag about it. So I'll put a pin in that for a second. But and it's actually interesting because InterRent is the best performing TSX cap REIT in 2025. But it's residential. And right now there's a lot of anxiety around apartments and you know, the market there. You see these very splashy headlines on the front of papers, you know, just saying it is grim out there. You know, the government's pulling back on immigration. And so that's a reduced source of demand. Apartment prices are starting to come down. How do you think about, is that an area you're totally staying away from? Is it poised to get worse? Because you know this better than anybody. We're always waiting for housing to collapse in this country, right? For the last 20 years, we've been waiting for housing to collapse in this country.
Yeah. So I would say take a step back. What you'll find is that all of the G7 nations have got the same housing problem. There might be one country slightly ahead of another, but we all have the same problem. In that people want to come to the G7 countries because, you know, there's a separation of church and state. There are property laws. You know, generally in any of these 7 countries, if you work hard and you save some money, you can actually get ahead. You can have a better life for your children. What makes Canada slightly unique is that no one can walk here except for Americans, right? So, and I mean, all you have to do is look at the United States and their southern border. They have a huge issue with people walking to their country. And so they don't have control over their immigration the way we do. Most of immigration in Canada is economic immigration, over 60% of it. So we identify gaps in the workforce and we target those types of people and skills in other countries. So as much as our immigration, I won't say it's broken, but it was misused by the previous Liberal administration. And it looks like we're going to fix that eventually over time. But as much as we have an advantage over a lot of these other countries, you can see that we still have a very acute housing crisis in Canada. There's just too many people and not enough housing. So what do you do about that? We are at a stage now where it is such a crisis that we actually need the government to be part of the solution. And I can already see my LinkedIn inbox filling up with the vitriol from some of my private real estate colleagues around the country. But It would be one thing if we were short, 500,000 homes, right? That's 2 years worth of, traditional development in this country. Whether you're listening to the government whether you're listening to the Parliamentary Budget Office or you're listening to CMHC, we're 3 million plus homes short versus producing about 240,000 homes annually. So it is no longer a 2, 3, 4 year acceleration to catch up. We are now decades behind.
So what are you talking about when you say the government needs to give up? Because their current approach is we're going to build the houses, basically, versus the builders who say, just get out of our way. There's so much red tape, and that's why we can't do it. And we're hit with regulation after regulation, and it's just not economical for us to be building.
Yeah, so one of the problems particularly municipal governments have, so at the city, town, even village level, is that they've become too addicted to the costs around and the fees around housing rather than actually creating the conditions where businesses want to locate in their cities and towns. So what you've got now is, famously a few years ago, the city of Toronto doubled land transfer tax for transactions in the housing market, right? So there was a rush to transact before that kicked in. That's one huge example of municipalities going too far in terms of trying to extract value out of housing.
Because then people really think twice about selling or...
Well, worse, a disproportionate amount of your income now is tied to servicing real estate, whether it's owning it, living it, renting it, or transacting in it. And that's income that can't be used to consume or invest. And so more and more of our economic activity is tied towards housing instead of other things. So what I would say, just coming back to the government piece of it, you're absolutely correct. The government has been part of the problem in terms of raising the cost of producing housing, whether that's through land transfer tax, whether it's development charges or what have you. But the other issue is now we have priced so many people out of the housing market that what we're seeing now cannot continue. Right? There's the old number that if 3% of the population is in the streets, you have revolution. Well, I think more than 3% of the population of Canada and other G7 countries are having difficulty getting housing, whether it's renting it or owning it. And so that makes it an acute problem that we had really better pay attention to.
You hammered on, I think, the most important point, because it seems like we're talking about two different things. On one hand, we're talking about how there's not enough supply, but on the other hand, we're talking about all these owners are left with unsold inventory, and the reason is because of affordability. People can't afford it.
Yeah, but anytime you've got an extreme imbalance like we have right now between demand and supply, you'll have innovation, right? So you'll have people co-owning homes. I remember a girl that I went to high school with many, many years ago was on the front page of the Globe and Mail because she was one of the first co-owners in Ontario. So she bought a house with someone she had never met. She lived on the first in the basement, and the other family lived on the second floor. So you'll see innovation like that, where there are different models for home ownership. Laneway houses, where I lived in Oakville, somebody knocked on my door and said, "Can we turn your garage in the laneway into a housing unit?" And I was like, "Well, you're on the wrong street. I don't have a garage in my laneway." But increasingly, you're seeing that happen. So you'll see innovation. But I think what I want to circle back to is we have a problem where we have created too much demand, largely through immigration, and we have a situation where we've stifled supply. And so the solution is going to have to be a comprehensive solution. And I'm one of those few people who says there's no such thing as affordable housing. There's no such thing as affordable housing, affordable food, affordable healthcare, affordable oil and gas. Like, we don't go to farmers and say, we'd like you to produce affordable corn or affordable wheat, right? Wherever the market prices a commodity, it's based on supply and demand. Now, because we are 3 million plus homes behind, we actually need the government to get in and do two things. Make it possible for the private market to produce, seniors housing, student housing, single family homes, high density housing. But also you're going to have to fill the gap here on the affordable side, because this is going to take too long. Carney's plan is to double current housing development to 500,000. Okay, so what? Now it's going to take 6 to 10 years to close the gap? That's too long for the people right now who can't afford to rent or own. So we're at such an imbalance that we actually need the government to step in and actually create affordable housing. So as much as, some of my colleagues on the private side are like, we don't need the government building housing. Yeah, we do. Just not market housing. We don't need the government interfering with private developers and what they're doing. We need them to make it easier and more affordable and more, it's already wildly insane. You've got such a supply demand imbalance that rent growth and home price margins are enormous. What we need you to do is we need you to fill in the gap on the affordable side until supply is enough that it starts to offset the incredible amounts of demand that we have.
Have you talked to anybody about this? Because I feel like they've also got a communication problem. You have
Amber,
their
no
housing.
one's listening. Okay.
Well, they're going to listen to this.
I wouldn't presume to say that I have all the solutions, but Warren Buffett's the greatest investor who ever lived. He throws a huge party every year, invites 30,000 people, millions watch, tells them exactly how he became the only investor in the Forbes 500 list, and nobody listens. So if nobody's listening to him, despite his track record and success, it would be the height of hubris for me to think that anyone's listening to me on the housing front.
Well, they should, because the government is tying themselves in knots about, they get stuck on this issue. What was the latest one was, so do home prices need to come down in order for things to be affordable? And obviously the government can't say that, because then all the people who are sitting on homes, they don't want their value to go down. So you want two things, right?
Well, can I just point something out?
Yes,
Nobody
please.
Lives in a national house. Like, everybody keeps talking about home prices national. Nobody lives in a national house. You live in Toronto, you live in Winnipeg, Halifax, Calgary, or what have you. Okay, home prices in Calgary have generally gone up, but probably not as much or not the same amount as in Toronto or Halifax. So to talk about national home prices and whether all homes have to go up or come down is ridiculous. What we need is a partnership between the provinces, the cities, and the federal government to ensure that conditions exist everywhere in this country for us to produce more housing and for the government to step in and make it possible for a sustainable, affordable housing sector to evolve until we get supply to match demand. But when people start talking about we need house prices to come down, where, right? Nobody lives in a national home, right? So I would say in Toronto, Vancouver, and Montreal, home prices need to come down. Would I say the same thing in Charlottetown or in Grand Prairie? Probably not. In some of those places, home prices probably haven't appreciated all that dramatically and have trailed the national average. So I would argue in some of those markets, we don't need home prices to come down. They probably need to go up a little bit more if you can get more people to live in those places. So to sit here and say home prices must come down in order for affordability to be restored belies the fact that people live in one place, right? And so it's dependent on that market as opposed to just looking at the national average and saying all home prices have to come down.
Boy, I'm glad I asked you about this.
Yeah, I'm passionate about it because I really do think that it is a huge, huge issue that we're just not paying. Ironically, I know it doesn't seem like it, but we're not paying enough attention to it. And those who are tasked with coming up with the solutions, I feel are myopic, right? Home prices have to come down, whereas somebody over here says we need more affordable housing. Guess what? It's a comprehensive problem that's going to require a comprehensive solution. And
I've lost track of the number of task forces that have been announced, like in my career as a financial journalist, and all these little things, foreign buyers tax. Okay, now we're going to pull it back. Land transfer tax. Okay, now we're going to do this. And yeah, it's so disorganized. Everybody's running around like a chicken with their head cut off.
Well, I don't envy Gregor Robertson. He's the new federal minister of housing, and he's got a huge task ahead of him, and it's mission critical. Because again, when you start talking about Maslow's hierarchy, let's go all the way back to first year university.
Let's do it.
Shelter is at the very bottom of Maslow's hierarchy. So if people aren't getting shelter, they get really upset and really angry, right? And to my point about 3% of the population being in the streets, that is something that compels people to be in the streets, right? I mean, where we are in this location, I know there have been groups of protesters who've marched up and down this street. So if we don't address this in a comprehensive manner and actually start to make some progress here, we're going to have bigger societal issues. And it's not just Canada. Again, if you look at the G7, we all have the same problem, just to different magnitudes.
And it doesn't seem like any of them, or is there a blueprint anywhere in the globe that seems to be getting it right?
There was an article that was published. I don't know if I can say the name of the.
Yeah, you can.
So the National Post published an article. It was a relatively short article yesterday that I actually forwarded to a whole bunch of people and I posted on my LinkedIn. And it was the first time I saw anybody actually, outline a comprehensive solution to the problem. And I posted it and I didn't even editorialize. I just quoted from the article. And there were so many people who liked it and reshared it and said, "This is great, Dennis." And I didn't take any credit for it.
What was it?
It was a comprehensive solution that talked about affordable housing, that talked about increasing supply, absolutely reducing development charges, and the fact that we needed all three levels of government in the country to work together in order to have this solution come to the fore. And again, there needs to be leadership on the file. Like, this to me is two people. Carney, right, to empower Gregor Robertson to actually implement the strategy. Everybody else everybody else may have a seat at the table and can argue and complain or voice but it's those two people who have to sit down and actually empower and then, actually execute on the comprehensive solution.
All right. You're right. It's such an important topic, and we're going to talk about it. I continue to talk about it through the lens of some of these stocks. Let's dip into the mailbag. Okay, our first question actually is about a residential stock. This one is Minto Apartment Real Estate Investment Trust. The question is coming from Nugget Capital on X. I recently bought Mr. Mitchell's former top pick, which is Minto. It's trading at a massive discount and underperforming peers. Does he believe management should sell more assets and find a way to return capital to investors rather than linger on such a discount? This stock looks like it's really struggling to get above $14 a share.
Yeah, the challenge. So Minto is an apartment REIT, and their sponsor is Minto Communities. So as Minto Communities builds assets, Minto Apartment REIT has a right of first refusal to acquire those assets. So in the real estate business, we call that proprietary deal flow, and almost nobody has it. So we generally love it because it gives you the ability to buy assets off market. Now, the challenge for Minto is that it's a relatively new REIT compared to like CapREIT and Boardwalk that have been around for ages. So the portfolio is also very new. So there isn't the huge mark to market. There's a decent mark to market, but it's not the same quantum as say an InterRent or a Boardwalk. So that's one issue. The other issue that you have is that there were a couple of missteps by the previous management team that the current REIT is still sort of getting out from under. New management has done a good job of distancing themselves from previous missteps, demonstrating that they won't just acquire assets from sort of Minto communities if they're not accretive to the REIT. And so that's been solved. But so we no longer own Minto. And the reason we no longer own it is because it wasn't trading the way we wanted it to in terms of, it wasn't necessarily up on a day when all the other apartment REITs were up. And it wasn't necessarily down on a day when all the other apartment REITs are down. So to your point, when you add things to your portfolio, you expect them to behave a certain way such that the portfolio as a whole behaves a certain way. Minto wasn't doing that. And then if I look at Minto in comparison to the other apartment REITs, it's the smallest of the sort of core five, right? It's sub-billion-dollar market cap. It's got higher leverage, which the newer assets can absorb, a decent sustainable payout ratio, but you're looking at sort of 2 to 3% cash flow growth per year. I can get sort of twice that out of some of the other apartment REITs. So we don't own it anymore. It does trade at a huge discount, but you don't have to make it back the way you lost it if you're sitting on a loss. And then going forward, you want to be allocated to those apartment REITs that have really got the ability to, benefit from that huge mark to market in terms of rents and releasing.
Okay, so you cut your losses on Minto. Let's talk about RioCan. This one coming from Ali on X. Can you please ask Dennis about RioCan? Is it a buy for the long-term hold, And this one, when I think about the Bay, which we haven't talked about yet, closing up shop, which is, what a tragedy. I think RioCan got hurt.
Yeah, in the short term. And so what I would say is, first off, RioCan is primarily an unenclosed shopping center landlord. Focus on the big six markets. So that's Vancouver, Edmonton, Calgary, Toronto, Ottawa, Montreal. So we like the strategy. What they've done in more recent years is they've added residential to that. And so actually every day I drive past one of their now mixed use assets twice a day. And it's an asset. Well? No, we're out in the eastern part in the west end of Toronto. And so this asset used to have 3 quick service casual dining restaurants in the parking lot, and they tore them out and they built 4 residential towers, condos. And so where are those people when they move in going to shop? They're going to shop at the RioCan Power Center at the base of their building. So I see the synergies in sort of that mixed use asset. So RioCan Living, I think, has the potential to be a very, very strong and value additive component to the RioCan business. Now, you mentioned HBC. This to me looks a lot like Target several years ago, looks a lot like Zellers before that. And so what you have is a large box retailer that is struggling. It's tough to compete against Walmart and or Costco or Loblaws for that matter. And so they pick up stakes, and the most valuable asset that big box retailer ends up having is their leases, which are usually below market. So what ends up happening is that somebody, usually another retailer, buys the leases, puts their own locations into those stores, and enjoys the benefit of having below market rent for an extended period of time.
And isn't the concern though that, fine, so somebody like the Bay leaves and they'll be able to now charge higher rent eventually?
Yep.
Isn't the concern though that we're running out of big box retailers that can take up that space.
Yeah, so nothing says that you have to replace a big box retailer with another big box retailer. I mean, I'm shocked at how many office floors in Manhattan are now pickleball courts. Now, I've never played it myself, but it seems to be taking over Midtown Manhattan. Amazon needs tons of last mile delivery space, and space in a retail location is a perfect, I mean, you've already got the parking, you've already got sort of the transportation node there. So having last mile delivery for Amazon there is another potential use. More experiential uses, gyms, car dealerships. So just because you've got a big box retailer leave doesn't mean you need to replace them with one.
You mentioned RioCan Living. This is not intended to be a core part of their portfolio, right? Like, am I wrong? Did they announce plans to divest?
What they're going to do is they're going to sell like their condo assets. So they're never going to hold them.
That's right.
So they are always going to sell them. They have slowed down because the condo market is really challenged right now. But longer term, I think that is a strategy they're going to continue to keep at RioCan.
So you'd buy it here?
We owned it before the HBC news. We added to it on the pullback, and we'll continue to own it.
SmartCentres is another sort of anchored retail experience. You could call it that. This one coming from Kaiwal2 on X. I would like to hear Dennis's thoughts on SmartCentres. Can it be that simple? 94 developments and not having to use much capital because they build on their current properties. Seems like a huge win. Yeah, so the short answer is no. It's not that simple. So SmartCentres is a unenclosed shopping center mall. REIT in Canada. Typically Walmart anchor.
Yeah, so Walmart is the primary anchor at their locations. So what I would say is first off, we don't own SmartCentres. And the reason we don't own SmartCentres is because their cash flow growth has historically trailed that of some of the other retail names. So it's a very defensive portfolio. I mean, Walmart and shopping centers and bank branches, it's a very defensive portfolio, but we haven't seen the cash flow growth out of this name historically. In terms of their development, this is actually a name that used to be back in the day Callaway REIT, and the private developer was First Pro and then renamed SmartCentres. And then as the REIT got larger and the developer kind of stayed the same size, they eventually merged the developer into the REIT and it became SmartCentres REIT. And so there's always been a development aspect to SmartCentres, whether it's standalone or now in the REIT. The development, though, has expanded from just unenclosed shopping centers to include condos, seniors housing, industrial, residential. So I would say primarily retail, but also mixed use development. Now, the point that he made about not having to use not having to use a lot of capital is incorrect. It's not having to use as much capital because the biggest component of development is land, right? It's the most expensive component. So if you're building on land you already own, yes, you're reducing significantly the amount of capital you need, but SmartCentres has still got over $500 million of capital they have to fund for their development pipeline. So it's a not insignificant amount. I want to pick on that point of you said the cash flow growth, because it's got a 7% dividend yield. So are there concerns there, or you think they have enough to at least cover their dividend? Yeah, the payout ratio is close to 100% as well, right? So if their cash flow growth continues to slow, or if we go into recession and it should dip, I don't necessarily think the distribution's in danger, but you're certainly not getting growth out of a distribution if the payout ratio is 100% or higher. All right, we got a couple more stocks to ask about. We're going to take a quick break first. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, welcome back. In our mailbag, we've got a question from Stephen on X. 2 words, Dream Industrial. Can I hold it or should I upgrade? What do you think? Yeah, so Dream Industrial, as the name would imply, is an industrial REIT. The footprint is in Canada, the US, and Europe. In Europe, it's specifically, see if I can remember, Germany, the Netherlands, Spain, and France is where their footprint is. So we like industrial. The fundamentals are very strong, but they're slowing. Okay, so what I mean by that is that leases that are renewing this year are renewing probably with 20% rents that are 20% higher than the expiring rent. And that sounds fantastic until you realize that 3 years ago it was 50% higher. Okay, so still really, really high on the releasing, but slowing, and you can see where the trend is and the trajectory is going. So what that usually means is that the multiple will start to come down, right? And then you add in higher long bond yields, and multiples have come down significantly for industrial REITs. They're also economically sensitive. So if we're worried about trade in particular, that's going to hit industrial REITs. And if we're worried about tipping into recession, that's also going to hurt industrial REITs. So what I would say is that a good chunk of that is priced in. That's not to say that if we hit a recession that these names won't dip, but a lot of that impact has already been priced in at current levels. So if there is a subsequent dip from here, you should be buying the sector. In the case of Dream, its closest comp is Granite within the Canadian market. Granite is a little bit bigger. It's got a lower payout ratio, lower leverage. So Dream has suffered a little bit in comparison to Granite over the years because of those reasons. But I think we own both names, and I think if you own this name right now, you should be prepared to buy it on a dip and add to that position, and then you should be able to hold it going forward.
Let's talk about Northwest Healthcare Properties REIT. This question coming from KK Investing, also on X. The question is, it seems like they're stabilizing their portfolio and eventually having new owners of their Australian assets. Is there a CEO overhang? Thoughts? I feel like we need to backstory Northwest a little, because it was a hot mess for a while.
Still is.
Okay.
So Northwest Healthcare Properties REIT is a healthcare property name. They own hospitals, they own clinics, they own them in Canada, the US, South America, Australia, Europe. Like, it is a very, very diversified REIT. We don't own it. I personally don't like it.
Did you ever own it?
I have never owned it.
Okay, so talk to me about that, because it was a great stock for a long time.
Sure.
What were your red flags?
Well, first, it's over-diversified from a geographic and from a sector standpoint. So it's really difficult to be really good at everything. I mean, Michael Jordan was the greatest basketball player who ever lived, not so great a baseball player, right? So, Wayne Gretzky, greatest hockey player who ever lived, not so good a hockey coach. So it's really difficult for any one management team to be able to transact in multiple different property types and multiple different geographies and do it well, okay? So that's one red flag for us. The other is that healthcare properties tend to be operating businesses as well. Okay. So what that means is that, if I look at seniors housing versus apartment REITs, apartment REITs tend to have net operating margins of 60% or better. Seniors housing REITs, the best of them, have operating margins of 30%. So that shows you the difference, in a passive landlord versus an operating business. So when I look at Northwest, the operating margins are closer to seniors housing than they are to apartments. So that's another strike. And then, if I look at their second largest tenant, Healthscope, it's funny that this person said the portfolio is stabilizing. Their second largest tenant just went into receivership. And the plan from the receiver includes asking the landlord to take a haircut. So the outlook for cash flow growth for Northwest, there's a significant overhang, based on the fact that their second largest tenant is probably going to come back and ask for rent concessions. So
they've already cut the dividend. They had to cut it in 2023. They've got a 7% dividend yield. With that in mind, if somebody said, I'm just going to take a flyer on it, it's ultra cheap and I get this dividend yield, how safe would you view the dividend?
So I would never encourage anyone to take a flyer on publicly traded equities. This just doesn't seem like a good idea to me. Look, companies that have to cut their distribution once open the door to subsequently cutting it a second time. What I think a lot of people don't understand about REITs is that they have to pay out generally, like we're speaking about Canadian REITs now, they have to pay out 90% of their taxable income, if you will, to maintain their REIT status. So a REIT that continues to have cash flow can't cut its distribution to zero, right? They have to cut it to a point where they're still paying out that 90% hurdle. Now, if their cash flow continues to decline, they might be in a position where they cut their distribution again and again and again. So it's not like a REIT can say, we're going to cut our distribution 80%. They have to maintain that 90% payout. So just because they've cut once doesn't necessarily mean they won't cut a second time or a third time. So and the reason you cut is because your operating business isn't generating enough cash flow to service that distribution. If the outlook is for cash flow to continue to deteriorate because your second largest tenant is going to ask you for rent concessions, I think there's a pretty good decent chance that you might have a second distribution cut going forward.
Let's talk about, I want to squeeze this one in before we get to your pro picks, but InterRent. I mentioned this question also coming from Stephen. Do you think InterRent REIT will get taken out? It's the best performing REIT stock in 2025. There's an activist in there, and we actually interviewed him, Moaz Kassam of Anson Funds, who basically said this is an undervalued stock. It's got a huge, robust portfolio and thinks that there's a strategic transaction to unlock value. What do you think?
If he thinks all of that, he should go out and do it himself. I'm not so sure. I think there are a lot of people who would be interested in buying InterRent. Okay. And the reason for that is because they have a huge mark to market, meaning that market rents are materially higher than the in-place rents they are charging. And they've been very, very successful at capturing that. I also think that they've done a very good job of adding value to the assets that they own. So is there a lot of interest in InterRent? Absolutely. And I almost had it as a top pick today. The challenge, again, is if you're looking at the balance sheet, they have done a great job of maximizing their ability to utilize CMHC funding, which is very low cost. So there isn't the opportunity for a potential acquirer to step in and utilize more leverage per se. Okay. Then if I look at the markets that they're in, if an acquirer were to come in and sort of diversify into other markets, I'm not so sure that you would get the same rent growth and mark to market that InterRent has in its existing markets. So bottom line, it's trading at a discount to NAV. We own it in our portfolio. You're not getting it. You're not getting me to tender to an offer that's below NAV.
He didn't like the strategy of going out and buying assets, preferred that focus on buybacks. As a shareholder, do you have a view on how they've been allocating their capital?
Well, companies that have got leverage sort of at 55, 60, 65% probably can't do buybacks as aggressively as other companies that have got much lower levels of leverage. So, apartments, because they have the ability to tap into CMHC debt, have higher levels of leverage than other traditional REITs in other sectors. So I don't know that there's the opportunity to buy back stock to the extent that Moaz probably thinks.
The other question is, whenever you're talking activists, and he didn't say, I tried to get him, what's your view of management? And do you think that they're, right for the role? And he kind of danced around it. So I'll ask you, is management change a catalyst, or is it really just kind of figuring out what's the strategy going forward?
So I've known Brad Cutsey, the CEO, for over 20 years. I've known Michael McGahan, I think Mike is the chairman, but I've known him for almost 20 years. They are an excellent team. Okay, so there is no question about bringing in a superior team that's going to do a better job. So I'll leave it at that. But I'm pretty close to them. I know them very well. I've been able to, when people talk about companies, they say it's a great management team. And I always push back and I say, what does that mean? Like, what is management supposed to do? You give them capital and they generate returns on that capital. So if you look at the track record of this management team, their ability to take in capital, their ability to improve the assets, to capture mark to market, they've created a tremendous amount of value for unit holders like myself and my fund holders. So that's what I mean when I say I like the management team. They've done a good job. And, they've got an almost 20-year track record that you can analyze.
I just want to circle back and, I love numbers. So you said you wouldn't tender at NAV.
Well, why? If they're growing cash flow, then it shouldn't trade at NAV. It should trade at a premium to NAV.
So it's trading at $11.89. What's your net asset value?
Oh, I'd have to go back into the spreadsheet, but I think that we think it's worth like 15, 16 bucks, somewhere in that range. So you're not going to get us to tender below 15, 16 bucks.
Okay, good perspective. Now let's get into your high conviction picks.
Sure.
ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first pro pick is Killam Apartment REIT. Talk to me about why you like this one.
Yeah, so we like apartments in general, okay? You've got a huge supply-demand imbalance. And so as a result, you've seen huge mark-to-market growth in terms of when leases expire, the new rents have generally been higher. On top of that, what we like in terms of Killam, good balance sheet, sustainable payout, but also the market focus is in areas like Atlantic Canada, where you haven't seen the rocket ship growth in home prices and rents, which also means that you're probably not going to see a huge pullback if we do tip over into recession. And then we like the fact that they are dominant in Atlantic Canada, right? North of 10% market share in the big 4 or 5 markets out there. And then on top of that, they also have this manufactured home community business. Anecdotally, people like to call them trailer parks, but professionally, we call them manufactured home communities. That is a business that is almost recession proof. And the reason why is that most people who live in a manufactured home community are retired. So they have very little risk of losing their job and therefore their income to service their rent. Their rents are a fraction of apartment rents, like usually 10 or 12% of apartment rents. So when you talk about adding a 5 or 10% to their rent, you're talking about 10 to 15 bucks a month, as opposed to 200 or 300. So it's a much more sustainable defensive business model that is added to the Killam apartment portfolio.
I think it's interesting when we talk about the exposure. You said people don't live in a national house. They live in a place. And the concentration in Atlantic Canada, is that an advantage right now? Because we are hearing a different story when it comes to rent in maybe a market like Ontario, where they're less exposed.
Yeah, and so Killam does have exposure to Ontario. They do have some exposure to Western Canada, and they do even have some exposure to development. But it's much less than some of the others more Ontario or Alberta-focused REITs like Cap REIT or InterRent or Boardwalk. And so when I look from a geographic standpoint to the defensiveness of their markets, we do like the focus on Atlantic Canada for that reason. All of them have got, the same exceptional access to leverage. They've all got sustainable payout ratios. They've all got sort of sustainable leverage ratios. So it really comes down to, we like the defensiveness of Atlantic Canada. We like the defensiveness of the manufactured home community portfolio.
How much upside do you think?
I think most of the apartment names offer 20 to 25, maybe 30% upside, but then you have to start risk adjusting, right?
And that's a decent dividend yield, 4%.
Yeah, but again, remember, it's very tax efficient. So you'd probably have to find, bonds yielding 9% or stocks yielding 8% to match the after-tax yield from a 4% REIT yield.
Your second one is Chartwell Retirement Residence. And this, what a home run. It's trading near an all-time high, which I guess begs the question is how much higher can it go? And what do you see as the catalyst from here?
Right. So it's not cheap. It's actually trading at NAV or even possibly a small premium to NAV. What we like about Chartwell is, again, it is a derivation of housing. And so there isn't enough seniors housing, student housing, you name it in this country. We historically have not liked seniors housing. I already gave you the numbers on net operating income margins, 60% for apartments, 30% for Chartwell in this case. The reason we like it is because after the pandemic, their occupancy fell from sort of low 90s to high 70s. So right now, what you have a situation is you have 2 levers of growth on the top line. You have occupancy recovery, and their occupancy is now recovered to the low 90s, and they're targeting 95% by the end of this year. And you have significant rent growth driven by the supply-demand imbalance. So those 2 things are what allowed Chartwell to generate, I think it's around 45% cash flow growth per unit last year, and targeting over 20% this year, probably in the mid-teens for next year. No other REIT, no other real estate sector in this country has that type of cash flow growth potential right now. So we like Chartwell now because of that sort of short-term opportunity to capture both occupancy growth and rent growth. The occupancy growth is going to taper off after it hits 95%, but we'll still be looking to high single-digit rent growth because of the supply-demand imbalance.
But is it priced in?
I would say no. I would say that you're going to see. So let's say the Chartwell's trading at NAV. If that NAV is growing at 10% a year, then we should expect a 10% total return. 10% return plus the yield. So you're into mid-teens total return versus what are you getting from other sectors or other names? So no, I wouldn't say that it's priced in.
You brought to us a U.S. name.
I did.
Your third pick, Vici. Is that how I say it?
Vici, yeah.
Vici Properties, which is. Is it Caesars, like a landlord to Caesars Palace?
You got it. So Vici is what we call a triple net lease. So they don't pay any of the operating costs of the real estate. So they own the real estate. There's a fixed lease to the operator of the real estate. The operator takes on all the operating risk. So for instance, in the case of Vici, they own casinos. both in Vegas and outside of Vegas. And so MGM and Caesars and Penn Gaming, they are their tenants, and they take all the operational risk of running the casino. And so one of the interesting things about Vici is that its occupancy is always 100%, not 99, not 98, it's always 100%. And then when you look at how they've structured these transactions, they have no operating cost exposure, right? So, utilities go up. That is a function of the operator who actually manages the asset, like MGM. They have to stomach that. The other thing I like is that 40% of their leases, with a target of 90%, have got CPI escalation. So, we just came through a time period where inflation hit almost double digits in North America. All of that would have been passed through to the operators. So Vici would have been insulated from that spike in inflation. If the trade war does kick off and push inflation up, again, Vici will benefit from that because they flow it through to the operators and collect more in rent. So we really like this name. It's truly experiential, right? Who doesn't like to go to Vegas and, gamble a little bit? But it's not just Vegas, right? Vegas is more around conventions. It's more around sort of big ticket. It's not locals gambling. Outside of Vegas, if you're in Atlantic City or Missouri or what have you, that's really locals stopping off on their way home, boys going out on a night. And so that is less susceptible to economic peaks and valleys, right? When it's just people who are gambling in their local community at their, the casino they pass on the way home, that is less economically sensitive. Versus something like Vegas. I mean, the pandemic is one thing, but during the financial crisis, a lot of business travel was canceled, right? A lot of conventions were canceled, conferences. So Vegas is more economically sensitive, but the structure of the leases protects Vici from that type of economic downturn.
Does the uncertainty around the U.S. economy give you pause?
Not in the case of Vici. I would be more concerned about retail names. I would be more concerned about office names, industrial names. The triple net lease REITs, and in particular Vici, I think it's a great opportunity.
Is this a core holding for you, or do you see as an opportunity here? Like, what kind of upside do you?
And I'm going to get in trouble with Ed Petoniak here. I don't know that Vici is a core holding for us, but we've owned it for a couple of years now, and we're quite happy with it.
All right. Well, maybe Ed doesn't listen to the Canadian in the Money podcast.
Who doesn't listen to Amber Kanwar's podcast?
That's true.
Come on.
That's true. Actually, we are number 5 in the podcast store under business. But Dennis, thank you so much. I really learned a lot.
Hey, don't sound so surprised. I've been doing this for a while. I'm going to earn these gray hairs. So if we can do this again, that'd be fantastic.
I would love it. That's Dennis Mitchell of Starlight joining us. Make sure you tune into our next episode. We've got Stan Wong of Scotia Wealth. You know how to get your questions in. You can email us at questions@inthemoneypod.com or find us anywhere on social media @inthemoneypod. And we'll see you on the next episode.